Hello all and welcome to our latest Meet the Investor episode. Today we are speaking with Anthony Todd, founder and CEO of Aspect Capital, a leading global systematic investment manager with over $9 billion in assets under management. Thank you for joining us today, Anthony.
Absolute pleasure. Very good to be here.
Maybe we could start with you telling us a little bit about yourself, your career history, both before Aspect and since you founded the firm.
Yeah, happily. So in terms of history, just kind of going right way back to the very start, I read physics at Oxford University. Was very lucky enough to have actually studied physics with Mouracadeh and Marty Lewick, the A&L of AHL, a firm that might be familiar to many of you, one of the world's leading systematic investment managers. I went from physics straight into finance, so joined a stockbroking firm called Phillips & Drew, which was later taken over by UBS, and was working on the fixed income trading desk. So I actually joined Phillips & Drew right at the start of pretty much a 40-year bull market in fixed income. The interesting point for me, actually, of working in the fixed income markets at that point is surrounded by a huge number of very talented traders, and there was one common theme that I saw between all the very successful traders, and that was just the application of a highly systematic, disciplined approach, not necessarily automated approach, but just a real level of discipline, particularly with reference to risk management. Left fixed income markets, did an MBA, brief spell in consulting like everybody else who does an MBA, and then was very fortunate enough in 1992 to be approached by Mike and Marty and David Harding running AHL, and they offered me a role in the company at that point. At that point, AHL had about 200 million under management, 20 people. But actually joining a systematic company, as I said, having had that fascination with that systematic approach, it was just too good an opportunity to turn down. So worked at AHL from 1992 to 1997. Loved working at the firm, absolutely superb business to work in at that point. Spun off AHL in 1997 with Marty Lewick, at the L of AHL. Michael Adam was the non-executive director. Third member of the team, Eugene Lambert. Eugene Lambert had been head of trading system development at AHL, and the group has actually founded Aspect Capital. So we founded the company back in September 1997, launched our first fund, the Aspect Diversified Fund, in December 1998. So that's brief history.
And so what you referred to AHL, and for those less familiar with that business, yep. What do they do, and what does Aspect do in terms of the systematic trading?
Yeah, in terms of what we do, so we are a purely systematic investment manager, and the aim, the key underlying aim between all the programs, across all the programs we run, is the generation of returns which are uncorrelated with stock markets, uncorrelated with bond markets, uncorrelated with other investment styles. So the key aim of all our programs in Australia, we've launched two funds in conjunction with CFS. One is the Aspect Diversified Futures Fund, the other is the Absolute Return Fund. Both of those, as I said, entirely systematic in their approach, highly liquid strategies with the aim of generating returns independent of stock markets, independent of bond markets.
And with respect to the trading strategies themselves, are you investing in particular patterns or particular markets?
Yeah, I mean, our largest fund is the Aspect Diversified Futures Fund. That fund trades actually over 200 different markets, so it's highly diversified. We trade across 8 different sectors. Sectors which, some sectors are mainstream sectors, so stock indices, bond markets. But also harder to access markets such as credit, such as in the commodity markets we trade energies, metals, agriculturals, we trade currencies. So the way we generate those returns uncorrelated with stocks and bonds is, first of all, we have the ability to operate both on the long side and the short side of the markets, whereas obviously the majority of funds are limited to be long only. But the other element is that what we're able to do is exploit that diversification across 200 different markets across those 8 different sectors.
Are there particular patterns in those markets that you're looking for?
Yeah, in the Aspect Diversified Futures Fund, what we're actually aiming to capitalize on is trends, momentum. when we talk about kind of trends, what we're kind of talking to is sustained movements in markets, ideally over a period of say 2 to 3 months or longer. That would be our definition of medium-term trend following. We capture those trends through the application of 8 different what we term price filters. Those price filters are designed to actually strip out the noise, the underlying, strip out the noise of markets, to uncover the underlying trend or momentum in each individual market. At the fastest end of the spectrum, our fastest models will aim to identify trends over a period of a few days. Our longest term models will actually aim to kind of identify trends over a period of say 6 months or longer. In aggregate, as I said, the sweet spot for us is actually trying to identify trends over a period of about 2 to 3 months or longer.
So those trends don't necessarily have to go on for 1, 2, 3 years, like a long bull market or anything like that.
Not necessarily. There are some trends that we will actually hold for multiple years, but on average for winning positions, for positions where we're actually generating positive returns, for our investors, typically we'll be holding positions for around 6 months or longer. Positions, I think it's one of the great advantages of a trend following approach, is almost an inbuilt stop loss mechanism. So if a trend goes against us, we'll actually cut the position kind of quite quickly. So it comes back to that old theory behind any kind of investing: you run your profits, you cut your losses. That's what trend following naturally does.
And in terms of that correlation to bonds and equities,
yeah.
Is largely the reason because you're able to go short? I mean, if you're long a market and you're sort of following the trend upwards, are you not likely to be more correlated to that market?
It's a very well taken point, and I think it's one of the unusual elements of our trend following approach, or of trend following approach in general, is that although, as I said, over the long term our correlation with stock markets and bond markets is nearly zero, that correlation is dynamic, exactly as you've suggested. So in an environment where stock markets are rallying strongly, then a trend following approach will try to actually lock onto that positive trend, and there will be a degree of positive correlation to stock markets. But bear in mind, those stock markets, that's just 1 out of 8 sectors we trade. So there won't be a significant level of individual sector risk. Conversely, you get an environment, find yourself in an environment such as we saw in 2022, where you've actually got falling stock markets and falling bond markets. Then quite rapidly, within potentially a few days, or it could be a small number of weeks, our positions will have a cascade of positions with first our fastest models, then our medium models, then our slowest models, gradually locking onto that trend. And again, back in 2022, we generated very strong positive returns in an environment where we had falling stocks and falling markets. So we had strong negative correlation at that point. So, over the long term, the correlation is zero, but instantaneously, the correlation, we might be correlated or anti-correlated with stock markets or bond markets. And
you touched on the 2022 period. How else has it done through other down markets such as COVID and GFC, in terms of, has it identified the trends both upwards and downwards through those periods?
Yes, it has. We'll move on to periods when it doesn't perform, and I think it's really important the investors do understand times when we're in a position to generate strong positive returns, but also times when conditions are more challenging. But in terms of environments where the portfolio, where the program has been able to generate strong positive returns during the lifetime of Aspect. First of all, if we actually can look at the so-called tech wreck, the bursting of the technology bubble in 2000, that really ran from 2000 to 2003. Global stock markets in that period halved. During that 4-year period, the Aspect Diversified Fund was able to generate positive double-digit returns in each of those 4 years. The GFC you mentioned, 2008, again one of our strongest years. So again, we're able to actually get the right side of the stock market move, flight into quality and into bonds, flight into quality in currencies, into the dollar, into the Swiss franc, flight out of commodity markets. If you look at the COVID crisis in the first quarter of the year, we were actually able to generate positive returns for our investors. actually when we saw the kind of turnaround, the very kind of sharp rally in the markets, that was a more kind of challenging market environment. But during the first quarter, we were in positive territory and able to provide that diversification. But that kind of event, that kind of COVID event, is an example of a more challenging event because, of course, it was an exogenous, very sharp move. Wasn't actually well presaged in the markets.
I'm keen to touch on when these strategies are not as successful in the moment. But before we do that, just going back to the team and the work that goes into identifying these trends, can you give us a little bit insight into how these trends are identified? I mean, is it as obvious as just watching a market go up and buying and sort of watch it go down and not? And how's that work?
I mean, I think the first thing that's important to say is that within the Aspect Diversified Futures Fund, we have an 8% allocation to those 8 price filters that I talked about a little bit earlier, and I'll talk more about those in a moment. We have a 20% allocation to what we call modulating factors. And those modulating factors are deliberately designed to be, we use the term orthogonal to the kind of trend following filters. And what they are designed, they are again looking to identify other persistent drivers of market behavior. So it could be technical effects, could be more macro effects, it could be looking at timed carry, relative carry, cross-sectional momentum, sentiment value, kind of relative value. So if you look at periods which are kind of tougher for our trend following programs or trend following models, those modulating factors are designed to provide uncorrelated returns. And over the course of the last few years, that's exactly what they've been able to do. If you look at the kind of trend following models, the trend following models, as I mentioned earlier, is a range of 8 different price filters. And when I talk about a kind of price filter, the point is that any market we look at, actually to a first approximation, the price movements are random. It's pretty much a random walk over short, medium, or long term. There's a huge amount of noise that's involved in any kind of price movement of any asset we're looking at. And so these price filters are actually designed to kind of strip out that noise and identify the underlying trend or underlying momentum in each market. As I said, that momentum might be positive, it might actually be negative, and it'll look at that over multiple time frames. So having identified the direction, so we'll be looking at the weighted sum of the total signal of those 8 different kind of price filters. Then the kind of key elements is how do you actually translate that trend strength into a position in the market, and that's where the position function that we apply actually plays a kind of critical role. How do you, as I said, kind of translate the strength of the trend into an actual position in the markets?
How much subjectivity or human involvement is there in making those decisions?
I mean, once we've built the model and applied and implemented the models are implemented 100% systematically. We're very much of the belief that if you actually apply an approach, apply a disciplined approach, but then have a discretionary overlay, you're no longer systematic. You're no longer rules-based. You are a discretionary asset manager. So our approach is 100% systematic. Now, there may be times, and over the 25-year history of the Aspect Diversified Fund, there have been a handful of occasions where we have intervened. A good example would be actually ahead of the Russian invasion of Ukraine. Back in kind of 2022, we saw that there was a risk of that invasion. We saw that in January. The invasion, of course, happened actually during the latter part of February, and we were concerned about a collapse in liquidity in the Russian ruble and other assets we were actually trading. So we took preemptive action there, taking the view that actually there's no way that our models could have actually predicted whether the invasion was going to take place or not. We just thought it was an unacceptable, an unquantifiable level of risk. So that was an example where we intervened. But that, as I said, has literally happened maybe 3 or 4 times in a 25-year history. The rest of the time we've been 100% systematic.
And have there been occasions in the recent past where specific events that our listeners might be familiar with have driven very strong returns outside of those crisis periods?
Yes, I mean, I think what I would look at, examples I can point to, I think you can actually point to 2014. So come 2014, was a period where we saw the kind of shale gas kind of revolution in the US, and which led to a kind of cratering of energy prices. There was an expectation heading into kind of 2014 that the Fed might be about to increase interest rates. Actually, there was a slowdown in the global economy. We saw a strong rally in fixed income markets. So 2014 was actually our second strongest year in our history, and that wasn't due to any particular market crisis. I mean, I think it was a crisis if you're an energy trader, but it wasn't, for majority of investors, look at 2014 and think that actually it was fairly a benign market environment. But that collapse in stock markets, collapse in energy markets, that rally in fixed income markets, that led to very strong returns. I think you could look this year, as well, because so far this year we've had strong performance from the Aspect Diversified Futures Fund and from the Absolute Return Program. And in both cases, so we've actually had the strongest first quarter in our 25-year history, not our strongest absolute kind of quarter in the history, but strongest kind of first quarter in our history. One would look at this year as being a kind of crisis kind of type of period, but we've seen some very interesting idiosyncratic moves in the markets. Can talk a little bit later about what's been happening in some of the agricultural markets, what's been happening in the currency markets.
Please go into that now.
Okay. Yeah. since you asked. No, I mean, in terms of drivers of returns, actually so far this year, the two major drivers have actually been the cocoa market and what's been happening in the currency market. Two completely kind of different stories. And again, just kind of two market movements, strong market movements, which would be very difficult for investors to access in any other way. So first of all, in terms of the commodity sector, the commodity sector has always been a very important part of our program. We have over a third of our risk. I mean, clearly our risk can vary. It can be long, it can be short, it can be flat. But over the long term, we'll have more than a third of the portfolio risk in the portfolio. And of that one third, about a significant portion is in the agricultural sector. So about 11% of total risk of the portfolio is in the agricultural sector. The cocoa situation is an interesting one because for a number of years we always use kind of cocoa as an example of a market which just didn't exhibit any kind of trend following behavior, but we always kind of said, look, past performance is no guarantee of future results. It's always important just to be kind of patient, and just because the market hasn't trended for the last 10 years doesn't give any indication of what might happen in the next kind of 10 years. And it's that kind of patience premium which we think is so important. So we've always maintained a significant allocation to agriculturals, and cocoa is a significant and liquid market. What's actually kind of happened there is that due to weather conditions, it was actually first of all due to drought conditions at the end of last year. The crop growing conditions were actually very limited, so it was always going to be a kind of smaller crop than usual. The weather actually turned from drought to heavy rains actually kind of early this year, which just kind of compounded the problem, because the rains actually kind of led to a cocoa disease called black pod disease. So when the crop conditions were actually announced, there was a significant, it became very clear very quickly there was going to be a significant kind of shortage of cocoa this year. Actually, we started, when I say we, again, the trend, the upward movement in kind of cocoa prices actually started last year. We actually started building a position in cocoa about 18 months ago. Again, very much just based on that, on that kind of upward momentum, in the kind of cocoa price. Cocoa price actually, because this year up until the very beginning of May, had increased dramatically. Now, another very important kind of feature of our models is that as the volatility, as the risk in an individual market increases, we will systematically reduce risk, in that market. So we were able to kind of capitalize as the trend actually kind of rallied. We'd already built up actually kind of quite a material position as the price increased, and so the volatility of the market increased. Actually, over the course of the last few months, we've been kind of scaling back our position very significantly. So I think often in situations like this, we're contacted by journalists kind of saying, so are you driving up the price of this market or the other market? We've certainly been asked, are we driving up the price of the cocoa market? Absolutely not. We've been actually selling into the strength of the market actually for a number of months now. The position size we have now is negligible. So cocoa is one interesting example. The other significant driver of performance actually so far this year has actually been in the currency markets. As we've seen, it's such a marked shift from what we saw seven or 8 years ago. Where 7 or 8 years ago we were seeing coordinated interest rate kind of policies, coordinated central bank policies. We're now seeing dispersion of central bank policies, dispersion of economic regimes, and that's actually kind of led to some very interesting opportunities in the currency markets, particularly in the yen. So far this year, we've seen very strong performance in our positions with dollar against the yen and euro against the yen.
Okay, great. And going back to something we were going to touch on earlier about when the strategy
when it doesn't work,
do not work as effectively, what sort of periods are they less effective in?
And I think it's so important that investors do understand that. There are two environments when trend following won't work, doesn't work, hasn't worked. Those two environments are one when markets are range bound, when markets just come trendless. And we actually very much kind of saw that during the period 2015, 16, 17, 18, kind of by example. Again, quantitative easing, zero interest rate policy, central bank coordination, limited the scope for markets to manoeuvre.
So this would be most markets. So there'd be share markets, bond markets, commodities,
exactly.
across the board.
So when it happens, there was clearly a very strong rally in some equity markets over that period, but more challenging conditions in short-term rates. They were pegged to zero. Differentials in interest rates are a key driver of currency market behaviour. Well, there wasn't any dispersion in terms of interest rates. They were all fixed at zero or negative. So kind of currency markets weren't actually trading. Fixed income markets, again, negative yields, limited room for manoeuvre. So an environment like that was challenging for us. The other conditions which are challenging for us is when you see a very kind of sharp reaction in the market over a matter of, say, a few days against the prevailing trend. A good example of that would have been, for instance, during the SVB crisis in March 2023.
Silicon Valley Bank in the US.
Exactly, yes. Yep.
And so extending off the back of that, the environment we're in now and going into structurally higher interest rates, geopolitical risk, interest rate uncertainty going forward, how is a strategy like this there's likely to be volatility, but there's also likely to be uncertainty and potential range-bound behaviour as a result, up and down, not necessarily trending.
Well, always difficult to opine actually kind of looking forward. And again, our approach is one which is entirely systematic. But I think our view is very much that we've seen a real seismic shift in the economic environment and the market environment from what we actually said that during those challenging conditions, 2015, 2018. And now with dispersion in terms of economic environments, dispersion in terms of central bank activity, we've got some banks, starting the easing cycle. So, for instance, if you look at the Swiss central bank, Swedish central bank have recently actually kind of cut rates. Meanwhile, you've got the US likely to actually kind of raise rates this year. ECB kind of ditto. That dispersion of interest rate kind of policy, coupled with the geopolitical uncertainties you've kind of talked about, coupled with the election in the US actually come later this year, that uncertainty to us can actually drive very significant directional returns in markets, which I think could actually lead to some very interesting returns for a portfolio such as ours, which is broadly diversified and when I say non-directional, it's agnostic about market direction.
I'll probably finish with one question, which is fairly topical. The development of artificial intelligence, AI, given that your process is extremely systematic and computerized, how has that development impacted what you're doing, or does it support it or create more competition?
It's an incredibly exciting development for us. I think, in terms of a branch of AI, we have a team that actually focuses on machine learning, that's built a set of 24 machine learning models, which are actually part of our multi-strategy program. They're part of one of our major kind of customized solutions. So it's an area we've invested in for many years.
So machine learning being that the computers are teaching themselves,
effectively evolving the models themselves as there's more price discovery actually becomes available. In terms of specifically kind of AI, it's something which we're extremely excited about. in terms of improving the efficiency of our research process, in terms of our developers improving the kind of coding, efficiency, right through to what we're actually kind of doing from a kind of marketing perspective. So it can, I think, improve efficiency, across the board. So we see it as being very much an enabler, significant enabler. The very slight note of caution is that in terms of our research process, we always can talk about our research process being hypothesis-led. We always start any research project with a clear hypothesis about the market behavior we're trying to exploit. The second point is we always, I think it's one of the advantages of our approach, is completely transparent. You're asking about the drivers of return so far this year. I can talk about exactly which model or models in which sector is generating a particular kind of signal and why it's doing that. So a slight caution is that in terms of our approach with whether it's machine learning or AI, is to make sure that we retain that hypothesis-driven approach and make sure we retain that transparency. And that means what we're not about to do is just throw a huge amount of data at large learning models and just trust the output. So it's, anything we actually can do in that area again has to retain that hypothesis-driven approach and ensure that we can continue to provide transparency to our investors.
Great. Anthony, thank you for your considerable time today. That was a fantastic way to unpick what can be a very technical but very interesting way of investing.
Terrific. Well, appreciate your time. Thank you very much. Enjoyed being here.